Hi, I'm Jason Lamb from SurePoint Advisors, and welcome back to another episode of Quick Clips. I recently read an article published by Dimensional Fund Advisors that I thought was relevant to the investment philosophy that we follow at SurePoint Advisors. Basically, the article talks about the long-term performance of the S&P 500 from January 2000 through the first half of 2019. Over the 2 decades, the returns have varied sharply. Due to the recent outperformance, I find the S&P to be a very hot topic amongst investors, and some even ask, why not just own the S&P 500? After all, these are the top 500 companies in the United States, and most of the stocks are household names. Here at SurePoint Advisors, we say, not so fast. Let's take a look at the past 19 and a half years of the S&P 500 and see why we recommend investing into globally diversified portfolios instead of just the S&P 500. If we look at the chart, we can see from January 2000 through January 2009, the S&P had an annualized return of negative 0.95%. You may have heard of this referred to as the lost decade. This is not the return you would expect from an index that had averaged more than 10% annualized returns before 2000. January 2010 through the first half of 2019 was a different story for the S&P 500 with an annualized return of 13.08%. In this period, the S&P 500 outperformed the U.S. Large Cap Value Index, U.S. Small Cap Index, International Market-Wide Value Index, International Small Cap Value Index, and Emerging Market Index. Most investors have what is called recency bias. They tend to chase what is hot and quickly forget about what has happened in the past. Unfortunately, many investors are too late to the game and underperform the market. Now let us look on how the S&P 500 did for the last 20 years and remind investors why we believe they should be invested in a globally diversified portfolio. Nobody knows what the next 10 months will bring, much less the next 10 years. After all, we would hate to see our clients suffer annualized losses of negative 0.95% for 10 years like they would have from 2000 to 2009. So we say own globally diversified, low cost, low turnover portfolios, rebalance when necessary, and check in with your investor coach when you feel you are getting off track. We'll see you next time on SurePoint Advisors Quick Clips.